For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Randy and Jake Floyd of Floyd Financial Group will be your guides for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Good morning. It is Saturday. It's time for Show Me the Money with Randy and Jake Floyd, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. My name's Jeff Shade, and I'm just here to ask the questions, but of course the words of wisdom and solid advice, they come from Randy and Jake Floyd of Floyd Financial Group. And I'll start with you, Randy. How you doing this Saturday morning?
I came in this morning, the back door, Elizabeth was sitting there, and I was playing Boogie Wonderland.
Boogie Wonderland? Whatever possessed you to play that?
When I was growing up, it was kind of something we listened to, right?
Well, you don't have to have a reason to play Boogie Wonderland. Anyway, I'm glad that you did that. I hope Elizabeth enjoyed that. Jake, how are you doing this morning?
Of all the music you could play from the 60s and 70s, you play Earth, Wind, and Fire, Boogie Wonderland. I mean, there's so many great classic rock songs that came out of that era, and that's what he chooses to play. I'm doing great, Jeff. Thank you for asking.
I'm sure listeners are listening to this going, boy, I don't know if I'm with Randy or Jake on this as far as musical tastes go. But anyway, we always have fun here on Show Me the Money, and this weekend, of course, is going to be no different. We've got a lot to talk about. We appreciate everybody joining us here each and every Saturday morning on KSGF. Well, the Dow hit 40,000. Who would have ever thunk about that? What do you think about the Dow hitting 40,000, and how soon till we hit 50, do you think?
So Jake and I were talking, I don't know how many years ago. It may have been as many as 15 years ago now. Jake says to me, so could you ever conceive of the Dow being 25,000? Because we were talking about growth of the market and things like that. He says, you realize that's what you're saying, right? And I said, well, yeah, I guess that's right, So here's the thing we know. Looking back over our shoulder, markets are going to grow and continue to grow, and that's not going to change much. And as we print and put more money into the system, it always equaled one thing in the past, and that is the more money that went in, the more money found its way to asset prices, and I don't think this time is much different.
I think when you look at the levels of the market too, Jeff, to Randy's point, we've talked about this many times over the years. There's a lot of people that say, well, the market will do 10% per year. And while that has held true over the last, 50, 60 years or whatever, if you zoom out far enough, what you're saying by saying that the market is going to continue at 10% per year, which means it will be 8 times 20 years from now what it is now. And so if it's 8 times what it is now, that means you're saying the Dow is going to go to 320,000 over the next 20 years.
Wow.
And while that sounds astronomical and sounds stupid almost to say, the market does have a way of outperforming our wildest dreams, especially when it comes to inflation. Asset price inflation is largely responsible for the market going where it goes. People are like, what do you mean it's inflation? It's inflation. We've printed money. That's where all this has come from. It doesn't mean that it's not real money. It is real money, and those who are invested are reaping the benefits of that. But it may be shocking where we find ourselves 5, 10, 20 years from now in the market, and 40,000 seems like a pretty big number. It seemed like a huge number when, Harry Dent in around 2000. Mm-hmm. Dad always laughs when I say his name.
Really?
It's a great name.
Isn't it?
This guy's an economist, right? Harry Dent.
So Harry Dent has been one of those perma bears, right, where he always thinks the market's going to crash, at least over the last 20 years or so. In 2000, he predicted that the Dow would hit 30,000. Mm-hmm. And people were like, oh my goodness, man, you're totally off your rocker, because the Dow at the time was just shy of 10,000, I believe. And I reflect on that a fair amount because he was right. And it was within his time frame that it went quite a bit past, and it hit 30,000 and went more. But he's been wrong way more than he's been right. He's been saying that the market's going to crash, it's going to crash, and I stake my reputation and my career on it, and then it doesn't crash and all that. But in any case, the market does have a funny way of showing the people who are negative who's boss, so to speak. I don't say that in any dig at anybody, and there are a lot of people out there that are negative or feeling negative about this market. But I will just say that we need to be careful about getting too negative, because you can get left in the dust. If this market decides it wants to keep running and we're too conservative, we may not be able to keep pace with inflation, which is one of my chief concerns over the next 5 to 10 years. We need to make a good buck because we need to be able to counteract the inflation.
Yeah, and I want to talk about inflation in just a moment, but the Dow at 50,000 is 20% higher since last October. During that same period of time, S&P 500's up 23%, and the NASDAQ is up about 27%. So the question is this, is there still time to get in? I mean, where do we see this market going first? And then I want to ask you, is there still time to get in?
Yeah, Jeff, so I'm telling you that, and I've been telling a lot of people that, yes, I think there's still a lot of room to run. The thing we always have to look at is where are we measuring from? Because where we measure from makes all the difference. So, if I had measured from the high that we were at during COVID, looking back to March of 09, we had 400 and some percent rally. If I had measured closer to COVID till today, or December of 2022 through today, those are much different numbers. So as we look at really what the prognosis is, I'm of this school. I've always looked at, what's the money supply? You may remember this thing called quantitative easing that Ben Bernanke did. And one of the questions I saw in an interview, and I'll never forget this, they asked him, said, so Ben, all this money that we're putting into the system, what's going to happen to it? And he says, well, it's my hope that it will find its way to asset prices. Well, guess what it did? That's exactly what it did. That's what drove that rally from 09. He started QE in probably, was it 2010, I guess, Jake, probably, when he started QE. Yep. Then he went like 2.5, 3 years, had 4 different sessions of it. And that pushed the market up over 400%. This time we've printed $6.5 trillion. And of course, Jerome says, well, we're going to roll that money off the balance sheet at $90 billion a month. And let me tell you, they haven't done that.
Yeah.
And I don't think they're going to, because number one, if they do that, they're going to crash bond markets, and they don't want to do that. Number two, leaving that money out there, it's going to be a Ben Bernanke situation again. Where's that money going to go? People aren't going to stuff it in their mattresses. Some may. Right. But that money is going to find a home in asset prices, and it's mainly going to find it right now. We can see it already in the stock market and in housing prices, most likely, even though we have ultra high interest rates. We have a lot of baby boomers that own their homes, that are buying second homes. And it's just, I think there's still a lot of time to get in and move forward with this.
So what you're saying is that even though the Dow's 50,000, even though the market is doing what it is, that there's still room to get in. We've heard always buy low, sell high, but you're saying that this could go higher, and don't let this stop you from investing into the stock market.
Absolutely. There's a lot of money still on the sidelines, not in the market. And, if we can get this inflation thing under control, which we're going to talk about here in a minute, and Jerome Powell starts to lower interest rates, people are getting used to getting fixed interest now of 5 and 5.5%. When it goes back to 3, they're going to say, I ain't doing this anymore. I'm going someplace else, and they're going to run to the market.
Right. Do you really think that the home loan interest rates are going to go back to 3%, though, ever in our lifetimes?
Well, that's hard to say, Jeff. I think that there's a few things playing on that. You may have heard about the continuing debt crisis we have in this country.
I heard something about it somewhere. I don't know where, but yeah, I know what you're talking about.
As we go to refinance that debt over the next 5 to 10 years, which a lot of it's going to come due and need to be refinanced, we can't really do it at current rates at 5% and stuff like that. And people won't rebuy debt if interest rates are high and they can go to the bank and get 5. They won't rebuy it from the federal government at 2. So they're going to have to force these rates down. And, the recent news that Jerome Powell got that, hey, unemployment's going up, the economy is starting to slow, all those things had to be music to his ears, because that's what he's been waiting to hear.
I would say, Jeff, to your point about 3%, I don't know if we'll see 3%, but we'll definitely see 4%.
Okay.
3% is below zero federal funds rate, meaning you will have to print money to get it down that low. But 4% we could definitely see. 3%, 2.5%, we may not see that again. It's hard to say. It just depends on, if we have a real recession, we will see those rates again, because this Fed, especially this Fed chair and this Fed, will not hesitate to print trillions if they feel like they need to. They just need an excuse, and they will do it.
Right. We have to remember, too, Jeff, that banks are looking typically for a 2% spread between what they can borrow money for and what they loan it for on a 30-year note.
Talking with Randy and Jake Floyd of Floyd Financial Group, and we're talking about the state of the economy, the Dow hitting 40,000. In recent months, the Fed has all but abandoned its previous forecast of 3/4-point rate cuts this year, but a slowdown of price hikes has offered some hope that we're going to rekindle those plans. Do you think that that is accurate, that we still may see some rate cuts this year?
I think that we probably will toward the tail end of the year, and there's a little evidence out here that says inflation, especially on some of the core items, is doing a little better. Now, this report I'm looking at here is from April, year over year, 23 to 24, and basically all items, it said, rolled in were 3.4%. However, food at home was only up 1.1% across all the segments. Now, an interesting little tidbit in here as they broke down juices and beef and all these different canned vegetables and all this sort of thing. The one that kind of stuck out to me was the fact that hot dogs are up 7.1%.
Are you kidding me? What are we going to do?
I thought that was kind of funny. And then food away from home is up 4.1% year over year. And we all know since COVID, food prices are way up, but it has subsided some. Another one that was kind of interesting to me was the fact that motor vehicle insurance is up 22.6%.
That's incredible. Why do you think it's up so much, you guys?
Price of cars is up that much.
Yeah, the price of cars has driven that through the ceiling for sure. The other thing that's kind of interesting and valid for people listening to this is that year over year, the cost of at-home care and nursing home is up 13.9% year over year. I thought that was quite a number. And then also outpatient hospital services up 8.2% and non-prescription drugs up 7.7%. So I thought that was kind of some interesting numbers to look at. So the long and the short of it is I think we're going to see inflation get a little bit better. I think people have come kind of to the end of their credit cards.
Yeah.
And they're also kind of waking up and saying, you know what? I don't have to have that, and I'm just not going to pay that price for that. And that's the first thing we have to kind of get it under control.
Yeah, I don't need to buy a fourth vehicle in the last 6 months.
Yeah, I know what you mean. Or, do we need another 65, 70, 80-inch TV in the house, too? But at the end of the credit, that means that, you're going to have to pay cash for that. A lot of people don't understand that particular concept. Let's finish up here by touching on inflation just a little bit. North of 3% right now. The goal was 2%. Have we all but given up that 2% goal, do you think?
I think if you ask Mr. Powell, he will say no. We are definitely committed to the 2%. However, I'm not sure how much longer Mr. Powell's reign will be here.
He looks worried in all the pictures that I see.
He's trying desperately to not give anything away.
Poker face.
That's really what he's doing. Is he's trying to make sure that every word he says is calculated and does not have anything that can be read into, because if he gives this market an inch, it's going to take a mile, and inflation will reignite, and that will be, how it goes. So I think that's really what you're seeing on his face. But I think that if Powell were to not be the Fed chair, it's hard to imagine anybody more dovish than he has been, meaning more willing to print money. He makes Janet Yellen look like a red-tailed hawk out there looking for a meal. And Janet Yellen was about as dovish as anybody we'd ever seen before that. So I think it's likely that a new Fed chief would be more hawkish. However, Donald Trump has been on record several times about wanting a dovish Fed president. So who knows? He may just keep him around, or he may find somebody else who's even more so. But all that remains to be seen over this next cycle.
Talking with Randy and Jake Floyd of Floyd Financial Group. We're glad you could join us on this Saturday morning. We've been talking about current events. We've talked about the Dow hitting 40,000. Is it too late to join the bull market? Future values, recession, all that and more. If our comments resonate with you, you'd like to get in and sit down with someone who can really make sense of this market and where you fit into this picture, we invite you to give us a call here at Floyd Financial Group and set up a conversation to sit down with Randy and Jake, talk about your individual situation. No cost, no obligation, no judgment whatsoever for this consultation. Get the conversation started right now by calling 417-889-7233. 417-889-7233 to request your no cost, no obligation, no judgment retirement plan or a review of that retirement plan with Randy and Jake here at Floyd Financial Group. I know it's the weekend, but go ahead, give it a call, 417-889-7233. It'll be less than 60 seconds of your time to set up this call. Ashley will call you back during the week and set up an appointment for you to talk with Randy and Jake. So take advantage of this opportunity right now. 417-889-7233. You can find out more about the firm online at floydfinancialgroup.com. And remember, this one call could make all the difference. Time for a break, gentlemen. When we come back, we'll be talking about this delicate dance of risk and reward when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Randy and Jake Floyd, with Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in this segment, we're going to be talking about risk versus reward and understanding the intricate dance.
That's right. The stock market can be unpredictable and complex, so having a good grasp on how to mitigate risk is essential. We were talking during the commercial break about this particular segment, guys, and I was thinking, without risk, is there any reward? So I want to dive into this a little bit, how it plays into risk tolerance versus risk capacity. So let's just leave it there.
For sure. So I think you're exactly right, Jeff. If you don't take any risk at all, it's hard to have much of a reward unless you... what's the old saying? Man who stand on side of hill waiting for roast duck to fly in mouth, soon starve to death, right? Something like that. But, you can wish for things, and then you can work and understand and take a risk that you can stand, which is one of the things that we're going to talk about during this segment, because a lot of times when retirees come in to see us, or people that are looking to be retired in the next 2 to 5 years, they're looking for sometimes the magic bullet of investing that will carry them for 30 years through their retirement. And so it's like, I want to do this once and I want to be done with it, right? Mm-hmm. And unfortunately, that is just not life and not how retirement works. So we're going to cover in this segment some different things that I think will really help to clarify this, a proper approach, if you will, to diversifying, compounding, and all the things that come into play, risk mitigation when you're in retirement.
Okay, so risk tolerance versus risk capacity. Let's explain that first. They're actually two different things.
Risk tolerance basically says, well, Randy, I'm willing to take a 50% drop or 10% or 20%, whatever the number is. Mm-hmm. I don't have many people say they're willing to take a 50% drop, not if they're near retirement. But, most people have a limit as to what they will take, 10%, 20%, 25%, whatever that may be. So that is their emotional capacity or tolerance, if you will. Now, there also becomes this thing, depending on how much money you've saved and how much income you're wanting to pull from your portfolio, there's this thing, what is your actual capacity to be able to take risk, especially if you're trying to really, really maximize what I would say, take the very most income I can take out of a portfolio. Now we've got a totally different equation we have to look at, because what we have to look at as advisors is, how much money can these people take? What is the capacity of risk they can take and not run into trouble spending the amount of money they need out of this portfolio each month and each year?
I tend to err on the side of safety, maybe taking too much safety or too much security. Is that something that you find a lot of people do? And if people do that, is there a danger that they will not grow their wealth enough to sustain themselves for a 30-year retirement?
Well, historically, if we look back when interest rates, were nearly zero and the bank was paying us 0.25, some banks had the nerve, the audacity to pay 0.1%. However, I will say this, when they could go to the federal government and get it for 0 to 0.25, why would you pay a depositor? You wouldn't, right? So that's where we were. So if we were really, really conservative, there's been a lot of money left on the table, and I would potentially say lost, because that's kind of what it is, for retirees looking back over her shoulder from 2020 for sure back to 2007 or 8, maybe 9, where, boy, things were growing and interest rates were really, really low. So, yeah, taking not enough risk in that case has cost people a ton of money.
So as your age goes up, should your risk tolerance go down necessarily? I mean, is there a point in time where you just don't want to have anything that's risky at all? Or as you go through retirement, do you always have to have some element of risk?
Yeah, so that's a very broad spectrum that we have to look at there, because we have people that need every dollar that they've saved and they can't afford to lose anything in retirement. And then we have people that realistically, let's talk about the ultimate, the big end out there. They got 10 or 12, $15 million, and they're wanting to spend $25,000 a year, and they can't live long enough to spend it if they make nothing, right? So you have everything along that line of spectrum, which from the 10 million to the person that's maybe got 50 or 100,000 saved. And so as we look at that, we have to factor all those things into tolerance and capacity, as we've been talking about.
And we've talked about the 5 things that money can do for you. Everybody wants an investment that provides cash flow, security, growth, liquidity, and tax savings. Not one investment can do all of those. But in this segment, we are talking about security. So does diversification lower your investment risk?
It absolutely does, and that's one of the things that sometimes we find people that, let me give you a case in point. So around here we have some companies that have done really well over the years. One of those being O'Reilly Automotive, the other one being Jack Henry. There's 2 or 3 other ones here that have done, really, really well, but those 2 are the ones that come to mind right now. And if you aren't careful, you can get really overly invested into these companies. And as my dad used to say, every dog eventually has its day. And what it really gets down to is sometimes they get so invested in one company that they cannot make intelligent investment decisions, because now they have such a huge tax burden that they can't bear to pay, that they can't make good logical decisions. So there's a whole lot of things we're talking about here, I know, but this is all the stuff that has to be considered as you enter retirement. Of course, if you're dealing with straight up retirement accounts, most of that money is pre-tax. If it's a Roth, of course, it's after tax and doesn't matter so much. But if you got just investment accounts, brokerage accounts, and that sort of thing, money that you've saved, all these factors come into play.
We're talking about the delicate dance of risk versus reward with Randy and Jake Floyd of Floyd Financial Group. Once again, our telephone number, 417-889-7233. Let's talk about different aspects of the market. Let's talk about stocks. So stocks, you get high rewards, but also you have higher risks. Do you necessarily have to have higher risks with stocks, or can you mitigate the risks with certain types of stocks that will still give you better than an average reward, so to speak, or the better than the sort of reward you would get with cash and CDs?
Yeah, so let's talk a little bit about the different types of stocks one can invest in. So there's penny stocks, and those are, very volatile. And do people make money there? Yes, they do. But honestly, they're gambling there because nobody knows where a penny stock's going to go. Then we have stocks that are what we call growth stocks, stocks that have been proven to be valuable concepts that are on the grow, and they're not paying any type of a dividend because they take all the profits they make and reinvest them to continue to expand and grow that business. Then eventually one day a stock will become maybe a dividend-paying stock, and that's where maybe it's, maximized most of its growth, but it's still a very viable business, and now they pay a dividend, and there's a lot of people that love dividends getting paid, to them each and every month. And when you get into stocks that are of good size, that are mainstream businesses and are paying dividends, yes, you're going to have volatility, but you don't really have what I would call pure, true blue risk. Now, what is the risk in retirement? The risk in retirement is that we have a 2009 event, a 2000, 2001, 2002 event, the dot-com bubble. We have a COVID event, all those sorts of things. But generally speaking, if we look back over history, since 1984, as of what the S&P 500 was on that day, the market has grown 3,364%. In 40 years. Wow. And now lately, have you been hearing the touts of investing in gold?
Oh, yeah.
So over the same time frame, gold has increased 6.6 times. So the market has outperformed roughly 5 times. While gold has its place maybe in a portfolio, it doesn't pay any dividend, it doesn't create anything, and that's why it hasn't been able to compound like the stock market. So again, is the market great at making gains? Yes. Is it good at protecting gains? No. But we have tools that we can use in relation to the market that help us to do that.
So on the risk-reward scale, we have stocks possibly at the top being possibly the most risky depending upon the stock. And then at the bottom, we have cash and cash equivalents, which, as you said, sometimes can pay less than 1% in terms of their interest rates. What is below stocks? Where do exchange-traded funds fall into this equation, this conversation?
So an exchange-traded fund, think of it this way. Most people that have money in 401ks, 403bs, 457 plans, retirement plans that is, are invested in mutual funds still. That's what's out there. The ETF looks very similar to a mutual fund because it's a grouping of stocks or bonds. The main difference is the mutual fund is generally managed. They have a group of managers or a manager that makes all those decisions inside the mutual fund, and they cost a little bit more to own because that manager has to be paid. The exchange-traded fund can be a group of stocks or bonds, but it's an unmanaged as a rule. Now, there are some managed ETFs today, but as a rule, they are an unmanaged basket, and many times they go by market segment, which it might be energy, utilities, could be consumer discretionary, consumer staples, it could be financials, it could be healthcare. Those are the market segments that they typically play in and what we typically play in. So the exchange-traded fund can be risky or it can be of lower risk, and it can also be all bonds. And so when you look at that, there's a whole gamut, if you will, of risk available inside the exchange-traded fund. It's not just a one-size-fits-all.
Okay, so the opportunity for most gain, and it has the most risk, things like stocks and, as I said, cash and cash equivalents towards the bottom of the list there. But where do insurance company products fall into this? And I'm talking about annuities. With something that is typically as safe as an annuity can be, is there really the opportunity to make much of a gain?
So it depends on the type of annuity that you are purchasing. So, we have three basic types. We have immediate annuities where basically that's like a pension program. You plug a dollar amount in and it spits out an amount for either one person's lifetime or maybe a husband and wife's lifetime. And now there's even some newer tools and vehicles that allow us to stretch that over multiple lifetimes. So we have those setups. We also have annuities then that are deferred. And inside the deferred annuity as well as the immediate annuity, we have variable type annuities, which means they're based on markets and have market ups and downs attached to them. And then we have fixed annuities that look like bank CDs. And then we have fixed index annuities that track like a market index like the S&P 500, the NASDAQ, or sometimes even the Dow Jones. So annuities can be a very good income producing vehicle. You have to be careful with what you buy out there. You have to really understand what you're buying. You have to understand who the company is and what their track record is, because not all are created equal. And you have to know exactly what you're using the annuity for. In many cases here, we will use annuities as a part of a portfolio to mitigate downside risk while still managing to get the lion's share of the upside, and it really can help to complement a stock portfolio in many cases.
We're talking about risk versus reward, understanding this intricate investing dance with Randy and Jake Floyd here of Floyd Financial Group. And based on our conversation here today, Randy and Jake, I would think that our listeners have some questions of you about their risk tolerance and their risk capacity. How much risk should you take to get the reward that you need? Well, that is a complex question, but I'm sure that Randy and Jake have some insight into that. So if you'd like to sit down and talk with them on a one-on-one basis to get your questions answered, it's not going to cost you a dime. Call this number today, 417-889-7233. Well, I know you're listening here on Saturday. You're thinking to yourself, they're not open. Well, here's what you can do. Go ahead and make that call right now, 417-889-7233. All you've got to do, leave your name and your telephone number. Ashley will pick that up, and she'll call you back during the week to set up an appointment for you to sit down with Randy and Jake and talk about your individual concerns about getting towards a confident retirement for you. Again, there's no cost. There is no obligation for this whatsoever. Take advantage of this opportunity. There are still slots available for you to have that conversation. Get this conversation started today by calling 417-889-7233. You can also find out more about us online at FloydFinancialGroup.com. It's FloydFinancialGroup.com. Time for a break, gentlemen. We'll be right back with more of Show Me the Money and talk about 10 factors to consider in checking the health of your retirement account portfolio and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Randy Floyd Jake Floyd and Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to be talking about 10 factors to consider in checking into the health of your retirement account.
Right, and every year with my health, I have what's called a wellness check. I go to my doctor to make sure that my body's on track to make me live for another 30 or 40 years, and it's the same thing with your retirement portfolio. You want to know if there's something going awry before it becomes a big problem. So that's how I'll frame this particular segment. 10 factors to consider in checking the health of your retirement portfolio. So let's count them down here, gentlemen. What is the first thing on our list? Not necessarily in order, but what is the first thing that we want to talk about today that we want to check on?
Yeah, sure thing, Jeff. And this kind of plays right into what we just talked about, the risk versus reward. So number one, I would say, and we see this a lot, is, lack of diversification. And diversifying, the spreading of risk, if you will, is very important inside a retirement portfolio because, if you have all your money tied up in technology and technology takes a 35% bath and you're living out of that, that's going to hurt beyond belief and you can't do that. So diversification helps us to level out or mitigate those drastic turns in markets.
And I talked to a gentleman once who claimed that he was diversified, and when he listed off all of his investments, they all happened to be parts of a computer. I mean, he had all of these things. He thought that was diversification. Well, those things will rise and fall in lockstep. Really, we're looking at uncorrelated things, right?
Right. So, there's this thing called asset allocation, and then there's diversification. So asset allocation is really what we're talking about more. What segments do we have money allocated to? Do we have fixed income? Do we have stocks? And what stocks do we have? And what market segments do we have covered in there? And then even within the market segment, say it's consumer staples, like that's Procter & Gamble and Gillette and Folgers Coffee, Heinz and Kraft and all those companies. We want diversification in there as well, even though that's a similar asset allocation in consumer staples.
All right, so we're talking about the factors in checking the health of your retirement account portfolio, and the first one here is going to be diversification. What's next on the list, do you think?
So this one I like a lot, inadequate risk assessment. Now, what do I mean by that? Most of the people listening to this program, I say most, have or have had a 401k. And when you have a 401k and you go out and you look at your investment options, how did you choose what you invested in?
Well, when I had one, it was just a pure guess because I had nobody I could talk to like the other 50% of Americans who don't have anybody they can talk to about financial concerns. It was a guess on my part.
Exactly right. And even though your 401k custodian, whoever it is, they're supposed to have this fiduciary duty that says, hey, we're here to help you and help you get this invested right, because the 401k is a pretty serious vehicle, and the government says, you need to be protecting your people here.
Randy, I think that in the over 17 years that I've been here, I don't think I've ever heard somebody say, yeah, my HR department was very helpful in getting my 401k allocated.
That's true. So here's what's happened, especially over the last few years, especially as these have become a thing. There are these things called target dated funds or lifestyle funds. There's so many names for them that basically say, hey, in the year 2029, I'm retiring, so this is what you need to be invested in. So I will tell you, if you go out and you look at that and you compare it against the S&P 500, every time they always lag the broad market.
Like a lot.
Yeah, I don't mean just a little bit. I mean like half or more in many cases. And it's based on the fact that what they tried to do was, can I say this, dumb down the process
of course.
Of, we're going to put a few bonds in here, and as you get closer to retirement, we'll put a few more bonds in there to mitigate risk. But honestly, for the looking back over her shoulder, that just wasn't a good time to have any bonds for a long time. And now it may actually start to reverse itself slightly.
What they've really done is enrich mutual fund companies, which is, American Funds, Invesco, BlackRock, TIAA-CREF, a lot of these big providers that do these. It makes it so they buy their fund and they never sell their fund. And that's exactly what they want. They don't want you to diversify away, right? The investment business is kind of a dirty business. There's a lot of stuff that takes place in the investment business that really is not intuitive and does not make a lot of sense and grossly enriches the big investment banks. And I think that it shouldn't be that way. And I think a lot of people think it's not that way, but I promise you that it is. If you look inside those target date funds, what you'll find is it's a mutual fund wrapper for which they charge a fee. And inside that wrapper, let's say it's the BlackRock 2040 fund. Inside that, it'll be 10 other BlackRock mutual funds, of which they're also charging a fee. So they're double dipping everybody, and it's incredibly profitable, and 60% of all retirement assets are in target date funds. So we're not talking about a little bit. We're probably talking $20 trillion or something in that neighborhood. I don't have the stat on that, but that would stand to reason.
We've talked about this a little bit here in the past segment, and that is inflation. When looking at your portfolio, what are we looking for to make sure that we've got a hedge against inflation?
Yeah, so, we've always had inflation. We've had a few periods of time back over history where we did have some deflation. But as a rule, we want a small amount of inflation in our economy. And people say, well, why would we want inflation? Well, if you go buy a house today, Jeff, you want it to be worth more 10 years from now, not less. Mm-hmm. Yeah. Right? So we want a certain amount of inflation is healthy and helps people to build and protect wealth, right? But you can't ignore the fact that, we've had a real rough time with inflation here. And then even looking back over our shoulder back in the 70s and the early 80s, we had some problems there. But for the longest time, we did not have a really strong inflationary problem here. In fact, I would say if you look back over our shoulder, our inflation history, even with all the big spikes and things, is probably around 3%. So inflation, you can't ignore it. It's not something that we can plan for. People say, well, how do you plan for 10% inflation? You don't.
Yeah, right.
you can't plan for that.
Sure.
I mean,
sure.
you just can't, because that would mean if you need 100,000 this year,
20 years from now you need 800,000.
Yeah, exactly right. And there's just no way to do that. So, and you need to think about the fact that each year it's going to take a little bit more. When we sit down and look at our income planning, we always like to look at two numbers. What's the bare bones number to keep the wolf away from the door, keep your family fed? And then what's our fund money? Because sometimes when things get tough, and nobody's going to like this, we have to cut back a little.
Oh, don't say that. I can't give up a thing. 10 factors to consider in checking the health of your retirement portfolio. We're talking about that with Randy and Jake. Lack of diversification is one thing we want to look at. Inadequate risk management, also ignoring inflation. Next one is high cost and fees. What are some of the things that we're looking for that may have high costs and fees associated with them?
I think Jake needs to talk about this one because he talks about this all the time to people, and he's got some great points.
Yeah, so I think if you had to pick one thing to keep an eye on in 30 years of retirement or 60 years of work plus retirement, the number one factor you should be concerned with is fees. Because the less you pay in fees, the more money you have. And if you have a relatively diversified portfolio, that's going to be the common denominator between whether you make a bunch of money and whether you don't. If you pay 1% less in fees over 30, 35 years, you're going to have twice as much money later because of the compounding of interest on that money you otherwise would have paid in fees. So we keep fees as low as we possibly can. We have to keep the doors open around here. But my average client bringing on today is probably between 0.5 and 0.6% total fees on their portfolio. Now, again, that's an overly simplified statement, but it is true that our fees are much, much less than a lot of the competition. A lot of advisors are 60, 65 years old, and they're starting to look for the exit. So they need to make as much money as they can. And guess where they're going to try to make that money? Off of you.
Right.
If you have somebody that's a little bit younger in the game that doesn't need to make all the money tomorrow, that's willing to charge a little less in fees, I think that's a good thing.
Right, and that telephone number to talk about your fees, 417-889-7233. Another thing I want to talk about in checking the health of your portfolio is rebalancing. How often should you rebalance your portfolio, or how do you tell when your portfolio needs to be rebalanced?
A lot of people, sometimes they'll come in and say, yeah, I noticed there's been quite a bit of trading in my account recently. Why is that? Do you get paid to trade? And we say, no, we don't get paid to trade. That's not what it's about. It's about this process of not only rebalancing, but actually re-looking at the marketplace in general and figuring out where to go next with money. The art of rebalancing, or the process of rebalancing, basically says this. If I build a portfolio, and let's say that in that portfolio I have a position of 3% for consumer staples. And consumer staples has a really good run, and all of a sudden, because of the appreciation of the price of those stocks in there, I'm at 5 or 6%. I am going to go back and say, you know what? We still believe that 3% is the appropriate amount for staples. So we're going to rebalance everything back to where it was. And that's just one segment. And most of the times there's 11 segments or maybe 7 or 8, 10 segments we're invested in. So that's what rebalancing is about. I think it's more a process of really looking at what your portfolio is doing by segment and figuring out what needs to be rebalanced and when.
We're talking about putting your portfolio through a wellness check with Randy and Jake of Floyd Financial Group. Next one is going to be tax implications. What are some of the things that we can look for in our portfolio that may help us mitigate taxes?
One of the things that we talk about here all the time is how do we, any money that we give to the government, you're just never going to see it again.
Right.
We don't want to give it away any more than we have to. And so along the way, as people are investing in 401ks and IRAs and all those tax-deferred accounts, sometimes people come in and say, should I be converting to a Roth IRA? Is that a tax strategy I could use to reduce taxes? And it could be that it is. It also could be that it doesn't make sense for you, depending on what your time horizon is for retirement. If you're 10 years out and you're thinking that maybe it's time for you to think about converting some of your IRA money to, or your 401k money to a Roth, it could very well hold water that would be important to you. But we have to look at what kind of income do you have today. What is the tax mitigation that you're receiving today versus the possible tax mitigation you would have, or the possible taxability of the money, and how much as a percent that might be looking forward. Now, nobody can predict that completely, but we should always be thinking about what are the tax implications and what are the best moves.
Right, and tax mitigation is very important in a portfolio. It is one of the things that you definitely should look for because taxes and healthcare costs, two of your biggest expenses during retirement. We'll talk about healthcare costs in a moment. So next one is going to be estate planning. How do we take a look at the health of our portfolio when it comes to estate planning?
Sure, estate planning, basically, people say, well, do I have an estate? Somebody thinks there's a magical number, I think, of wealth or something that creates an estate. No, we all have an estate. Sure. Some are just bigger than others, right? And some are more complex than others. But estate planning, you want to make sure that you know what's going to happen when you die. You want to make sure that you know who's going to get your money, and that's the person you want to get your money, and that it goes out in the way that you would want it to. And estate planning is one of those things you can get really in depth. And I say the best thing you can do is talk to an estate planning attorney, which we just happen to have one here in the building.
Right.
But talk to them and have them walk you through the process of what a good estate plan is and what it does for you. And then you will be able to make an informed decision.
And I mentioned that failing to plan for healthcare costs in retirement can create significant financial strain. So what are we looking for in our portfolio that would help us mitigate these healthcare costs?
Yeah, so, everybody has to think about, acute stuff, things we're going to get over. Most of our Medicare and Medicare Advantage and supplement plans, they're going to take care of most of that. The thing that really gets us, though, and can really get us, is if we have, maybe a really catastrophic setup to where we have to have long-term care. We have to have somebody at the house, or we have to be in a nursing home, we have to be in some type of assisted living situation. You have to figure out, is that something that you want to fund from your hip pocket? If you're a veteran, there may be some veteran benefits that could help you. There's some strings attached to that. It may be that Medicaid will be something that would help you with nursing home costs eventually. And it's just a conversation that you need to have with whoever your professional is in that area to determine what is best for you.
And I want to wrap up this conversation by talking about market timing. Does that ever work where people go to these schools and, they learn how to time the market? Does it work on a long-term basis?
Is it possible to time the market? Yes. But 999 people out of 1,000 will fail miserably at it.
Right.
And all you'll do is cost yourself money. There's an old saying that says that time in the market is more important than timing the market.
And Randy, didn't you have a neighbor that lived behind you who was timing the market, made a living at doing that? How'd that work out?
Yeah, he did really good for a while, man. He had motorcycles and boats and all sorts of things, and then all of a sudden he had this little red van and he was working 2 jobs. So
it rarely works out in the long run. We're talking about factors to consider in checking the health of your retirement account portfolio with Randy and Jake at Floyd Financial Group. Again, if you have questions about your retirement portfolio, you want to get a wellness check on that, Bring it into Randy and Jake at Floyd Financial Group, have them take a look at it, and begin this conversation by calling 417-889-7233. It's 417-889-7233. Go ahead and make that call this weekend. No cost, no obligation for that whatsoever. Leave your name, telephone number, Ashley, to give you a call back and set up a convenient time for you to talk to Randy and Jake. 417-889-7233. You can also find out more about our firm online at floydfinancialgroup.com, floydfinancialgroup.com. Time for a break, Randy and Jake. When we come back, we'll wrap up our show by talking about the 5-step process that occurs when you come see us here at Floyd Financial Group. All that and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Randy Floyd, Jake Floyd, and Jeff Shea.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And finally, in this last segment, we're going to talk about the 5 steps that we go through when people come in to see us to plan their retirement.
That's right. And when people call 417-889-7233, they come in and sit down with you. They have that casual conversation in the no-tie zone. They talk about their individual situation. They get some answers. And the next step is, okay, tell you what, I want to maybe move forward with this. Let's get started with this. So there are basically 5 major areas that you concentrate on. So where do we start with this?
Yeah, the first step, we call it discovery. So many times when people come in, the vast majority of the time, I've never met them before. And so we want to sit down and we want to learn about them, learn what's important to them, learn a little bit about their family and how their family dynamics are and what they're trying to accomplish, because at the end of the day, that's what's important, right? What one person considers retirement, another one would say, I would never do that. Yeah. So I had this guy that I said, hey, do you like to play golf? And he said, I hate that game. I said, okay. So, everybody's a little different. And so discovery, understanding people, learning what's important to them, and really listening to them. We got to know that first and foremost before we can get anyplace else.
Yeah, and I think too many advisors, when you come in and sit down with them, the first thing that they want to do is offer a solution. They want to sell you something without knowing anything about you. That is a major problem. Why do you do it the other way around? I mean, how does me playing golf or not playing golf or what relationship I have with my family, how does that affect how we're going to plan my retirement portfolio?
Yeah, well, all of those factors come in as to how much money you may or may not need to spend, and how you like to spend your time and what costs come along with that and what type of time commitment you have to that. I got into this situation where I loved to do triathlons for a while, and my dear wife had to endure me doing 2 and 3 hour training sessions 4 and 5 days a week for a while. She's in there watching me spin and sweat on a bike, right? And she's like, doesn't look like fun to me.
But it was. And I'm proud of you for being able to do that, too. But, if you were the client, we discovered that that's what you like to do. We have to plan for that expense. I mean, the spinning machine or whatever it is, and bicycles, too. I mean, you've got 1 or 2 bicycles, don't you?
I have at least 2, yes.
We don't want to go into how many bicycles. And how do you know how many bicycles is the right amount, Randy?
Well, the equation for that is N, which is represents the number you currently have plus 1.
Okay. And it's the same way with almost anything. With collectible cars, I know they're more expensive, but how many is enough? The number that you have plus 1. Anyway, it's, what do you like to do with your free and your spare time? We've got a plan for that. Coming up with a lifestyle portfolio, how much does it cost to be used? So that's where we start. Okay, so that's number 1. There are 5 steps here. What is the next step?
So number 2 is we kind of get to know about people. We call this analysis, and basically it's just kind of looking at, what's your Social Security going to look like if you have Social Security? Do you have a pension? What kind of money have you saved? Is it IRA money, 401k money, money in a savings account, all those different things? We want to look at that. Do you have a current house payment? Do you have any debt? All those sort of things come into where people are sitting right now. And are those things going to be a hindrance or a block to them getting retired? And how do we go about really working out the equation and the systematic, if you have that elimination of debt or whatever it may be, saving of money, especially maybe in your last few years, if you need to save a little bit more, can we do that? But honestly, we just want to know where people are And at that point, we'll talk about a budget, and people don't like to talk about budgets because, most of us boomers today, we've raised our kids, they moved out of the house, we're making more money than we've ever made, and we haven't thought about being on a budget in a while. And it's not that I'm trying to put people on a screw them down, budget. All I'm trying to do is figure out, what does it cost for you to live? Again, what keeps the wolf away from the door? Secondly, what kind of play money do you want? And oh, by the way, let's look at that, and does it make sense? And that leads us into the next process.
Right. We're going to talk about the next process, but on that budget thing, I don't mind a budget at all. It gives me sort of a very good look at where I am right now. And really with a budget, I can change that. I feel more in control if I've got one. So our 5-step process, the first thing you're going to do when I come in and see you, you're going to discover me, figure out who I am, what I'm all about, and what I'm up to. Secondly, you're going to analyze what I have in terms of assets. What is the third step?
Third step basically is where Jake and I go to the planning of your retirement. And we've asked you a lot of questions at this point that we haven't covered. I think we're going to learn about your risk tolerance and a little bit about how you feel about risk. And because, again, we have some people that come in and say, I don't want to ever see my account go down. Other people come in and say, hey, I'm good with the 20%. But you got to let me know what's going on and tell me how we're going to fix it type thing. So during the planning process, Jake and I go through a lot of different scenarios. We look at what makes sense, and we look at some portfolios and put together a plan. And then we talk about that at our next meeting where we've done the planning. It's not something like, hey, this is your plan, this is how it goes, and this is what you're doing. It's more of an open conversation, but we have a framework that we have developed that based on our conversations before we know would work. And then sometimes we have a little more discovery there. They say, well, that would be good except this or that, and we have to tweak that planning a little bit until we eventually get it right.
Okay, so what you're saying is that I have a say in this. It isn't just, okay, here's the plan I've come up with, and this is what we're going to do. I have the right to take a look at this and say that I don't understand it. Why are you doing this? And I think that we should do this. In other words, it really is a two-way conversation.
It absolutely is. And we tell people this all the time. At the end of the day, I'll tell you what I want. Jeff, if you're my client, I want your absolute happiness.
Right.
That's it. That's what I want.
Right.
And so if we can have good open conversations and really have good gut level conversations, it's a great process, and people love it, and we love it too.
So in this 5-step process here, as I said, you've discovered me, you have analyzed what I've got, you put together a plan, we finally agreed on this. What is next?
So next, it's implementation time. In other words, we're going to start the wheels moving. We're going to do the paperwork, make some phone calls for you if we need to move 401ks and that sort of thing. We handle it all. We make it easy is really what it amounts to. So we do this every day for people, and most people only retire one time in a lifetime. So we do all of that little minutia and all the paperwork behind the scenes.
Okay, so do you set up logins for me? I mean, how can I check on what's going on here?
Yeah, so, once your accounts are all set up, we have you back in. We have, login instructions, or we can help you with setting up a login if we need to. And then we start your income, and then we're going to, from there, once you're all settled in, we're going to go to that next step.
All right, which is going to be follow-up, but I want to really talk about one more thing before we get to that. I've got a financial advisor that I was using. I've come to you. I'd rather use you. I'm really not good at breaking up with people. Do you help us with that?
We can. So there's two ways that money moves around the system. I say two ways, but there's more than two, but actually there's two basic things that need to be considered. Number one, when breakups occur with previous advisors, we're happy to help you if you need us to engineer a breakup letter for those people. And it's not that we're out to get them. It's just that you've reached a different time in life, and you've moved to a new situation. And so you need a new situation with your advisor. Secondly, the industry itself, because of this, has developed a system called the ACAT system. And basically what it amounts to is most assets are movable behind the scenes, and there doesn't have to be a conversation with the advisor. And most people are pretty comfortable with that. And then again, when it comes to 401ks, which is where a lot of retirement assets come from anyway, I'd say 80%, maybe 90% of the people we talk to don't really have anybody they talk to on a regular basis inside that organization anyway. So we just do a rollover phone call or rollover paperwork or go out online and process the rollover, and there's not much of a conversation, if any, that ever needs to be had. But if there is one, we're more than happy to help.
Okay, so now we're up to the final step, which is follow-up. What is involved in the follow-up?
So the follow-up just basically is this. We get your income started. We're going to schedule a meeting about 90 days out to have you back in. We're going to do a couple of things there. We're going to say, number one, okay, how are you feeling about things? Are all your logins working? How does it feel income-wise? Are you got more money than month or more month than money? You know, what's happening there? Do we need to make some adjustments to that? And then also we'll talk about any questions they may have about the investments that we have out there and how they're working. You know, and then we'll just have a little catch-up time to just see how they're settling into retirement as well.
Right, and I've heard some people complain about their investment advisor. They say, well, he never or she never contacts me at all. How often do you follow up with people, or how often should they follow up with you? Is there a general rule, or is it that it just depends?
Yeah, it just depends a lot, because some people are really hands-on and want to meet every 90 days. Some people don't even want to meet once a year. Now, we like to meet with people at least once a year. But generally what we do when we have a new client, it's going to be 90 days. Then we'll have another meeting probably about 90 days out. And if they want to, we can continue that. But generally it'll graduate to a 6-month review. But they also know anywhere along the way, any day, we're a phone call away for help with anything that they might need, or if they just have a question in general. But we're going to have those 6-month reviews and then the annual reviews. I mean, we have people that we've had for 20 years that we see them, one time a year. We talk to them on the phone several times a year to answer questions, or maybe they need an extra little bit of money because they got a car that broke down, or they got a roof that needs to be repaired, or whatever it may be. They know they can reach out to us at any time. But we generally like to keep those to 6 months or maybe a year. And again, there are people that we meet with quarterly because that's what they want and that's what they're comfortable with. So we try to meet people where they are to keep them comfortable.
We're talking about the 5-step process at Floyd Financial Group, and that is going to be discovery, analysis, planning, implementation, and follow-up. Well, based on our conversation here, I'm sure that some of our listeners may want to be in touch with you to get this 5-step process started for them. Again, no cost for this consultation. There is no obligation whatsoever. So give this number a call this weekend while you're thinking about it. 417-889-7233. It's quite simple. Just make that call right now because phone lines are open. Now, Ashley may not be there on Saturday because she's busy doing what Ashley does on Saturday, but leave your name and your telephone number, and lovely Ashley will call you back during the week and set up a convenient time for you to come in and sit down and talk with Randy and Jake about your journey towards a confident retirement. Again, it's not going to cost you anything. There is no obligation whatsoever. And there is no judgment. Why wouldn't you make that call this weekend to make your financial life just a little bit more predictable? We can't make it 100% predictable, but we may be able to help you with yours. 417-889-7233 is the number to call. You could also find out more about us and request your plan online at floydfinancialgroup.com. Gentlemen, out of time for this week. Thank you so much, Randy and Jake, for your time. Have yourselves a great Saturday. For Randy and Jake, I'm Jeff Shade, and we'll talk to you again next week with another edition of Show Me the Money right here on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and are not intended as investment advice for any individual or entity. All information contained herein believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning offered through Floyd Financial Group, LLC, an investment advisor registered in the state of Missouri.